Hello, I'm Raul Elizalde with a quick take on the markets. Markets were on fire from March to December last year. The S&P 500 gained almost 70%, and that's just for US stocks. Foreign markets were even stronger. Europe was up almost 90%, Asia up 115%, Latin America up almost 120%. By year-end, one could only conclude that the place to put your money was abroad. Things are very different now. The S&P 500 has gone nowhere, so the rally has ended, at least for now. Foreign markets took a beating. Europe is down 8%, Latin America is down 7%, Asia down 5%. So the question now is, are we moving from a bull market to a bear market? Well, it might help to think about what is driving the current weakness. First is just profit-taking. The gains of last year had to come to an end, if nothing else, because people take profits. Few investors look at gains of the magnitude of last year's and have the stomach to leave all the chips still on the table. Profit-taking may have a lot to do with the current downturn. Second, there are a lot of questions about the strength of the US, and those questions remain unanswered. The jobless issue comes up most often, followed up by the piling up of debt, the never-ending weakness of the real estate market, the unwillingness of banks to lend, and last but not least, the complete gridlock that we have in Washington. At a time when the US is facing a very difficult financial and economic moment, one of the few things Congress is able to accomplish is to get the head of Toyota to testify about car problems. Well, this doesn't really inspire a lot of confidence that there is strong leadership to solve our current problems. And finally, the global issues are new and huge. First is China. For a long time, China had a rather bland foreign policy, had been happy to focus inwards. But increasingly, China is looking abroad and making its presence felt. It has invested $35 billion in Iran, is lecturing the US in economic policy. This year it has matched the US in how much oil it imports from Saudi Arabia, and this year, 2010, it will most likely push Japan as the second largest world economy. Well, the implications of this are potentially enormous, but since it came about very fast, the market is unsure of what those implications might even be for stock markets or commodity prices. And the final issue abroad is Europe. Tiny Greece adopted the euro a few years ago, and now it seems incapable of remaining a good standing member of the Eurozone because it has very serious fiscal troubles. The possible solutions to Greece's problems are: one, to be bailed out by Europe, which is unlikely, Germany doesn't want to do that. Two, for Greece to go through a brutal austerity period, which will have no popular support inside Greece. Or three, for Greece to simply leave the Eurozone so it can release the pressure through devaluation. But that has the potential of being a huge financial disruption, since it would expose fundamental weaknesses in Europe and can spill over to other Eurozone countries such as Spain, Ireland, or Portugal. The bottom line is that although the market weakness may be just because it is taking a breather from the hot pace of last year, the reality is that there is way too much uncertainty about the direction of the US, about the US ability to solve its own problems, and about crucial issues around the world. The market can take bad news, but it hates uncertainty. And until these uncertainties ease up, the market is not likely to show much strength. So the bottom line is, investors should be very careful in the months ahead and keep an eye on exit strategies to protect their portfolios should the market take a turn for the worse. For more information, please visit our website, www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.